Kevin, Liberation Day seems like a real long time ago. We've seen a whole lot of market gyration since then. So how are all these tariffs affecting the way you do business?
Sure, and we should put tariffs into context, at least from my opinion, because I view tariffs as presenting more of a growth scare than they do an inflation scare. Certainly an inflation scare over the short term, but more of an economic growth scare over the longer term. And this is the way I think about it, Greg. You have $100 to spend. Right now, you can buy 2 goods worth $50 each. If they slap a 20% tariff on both, now they each cost $60 each. So with that $100, you can only afford one of them and potentially look for a lower cost good to replace the other one that's now cost $60 or keep the money in your pocket. If you keep the money in your pocket, that's going to slow down the economy because 70% of our economic growth comes from consumer spending. So I'm keeping much more of an eye on economic growth and a potential slowdown or maybe a recession there than I am on inflation. And I believe the Federal Reserve is too.
But in the meantime, we've seen some bank earnings, and the investment banks are making a whole lot of money from the volatility. So how can your clients or retail investors make some money as well?
Yeah, I think retail investors were spooked by all this volatility. Remember, we haven't seen downside volatility in well over 2 years. But trying to time the market is an exercise in futility, Greg, because you got to get it right twice, when to get out of the market and when to get back into the market. I saw a stat from JP Morgan Asset Management the other day, which said that over the last 20 years, 7 of the 10 best days in the market took place within 2 weeks of the 10 worst trading days. And then I saw a stat from Wells Fargo, which showed over the last 30 years, had you just missed out on the 30 best days in the market, your returns would have gone from 8% annualized to just 1.8% annualized, below the rate of inflation over that 30-year time period. So stay invested, stay true to your risk tolerance, make adjustments to your portfolio as needed, but don't try and play this guessing game of being in the market and being out of the market.
So what type of adjustments are you making for your clients right now?
Some of the areas that you want to look to right now are the themes that were driving returns prior to the imposition of all these tariffs, such as increases in artificial intelligence spending, increases in defense spending. In fact, over the course of the beginning stages of 2025, we've seen announcements around significant increases in defense spending, both in the US and overseas. We saw an announcement just yesterday from NVIDIA that they're going to look to onshore and spend $500 billion in AI infrastructure developments over the next 4 years. Those two areas aren't slowing down, and I believe they present investment opportunities.
And what do you make in the recent decline of the dollar, for example? So talk about international investing, because we keep hearing a lot of folks going abroad and buying the European stock market, for example.
Yeah, I mean, 2 of the areas that are working right now, value is outperforming growth and international is outperforming US. And a lot of people are underweight international right now because US has outperformed international over the last 13 years coming into 2025. But now we see the benefits of geographical diversification, country specific and overall region specific. But don't forget about value stocks. Generally, you find a lot of value stocks overseas. So you can play both of those rotation themes by investing in international value-oriented stocks that typically pay a good dividend as well.
Okay, so if I'm buying value stocks overseas, are we closing the book on the AI trade?
Absolutely not. I believe that we're still in batting practice of a doubleheader as it relates to the AI revolution. And we continue to see commitments from large cap technology companies spending more on AI infrastructure. That's not going to slow down. And if you believe that companies like NVIDIA, Microsoft, Amazon, Alphabet are going to continue to grow and continue to be innovative, as I do, well, then this pullback has created some pretty attractive entry points for those stocks to consider, as now valuations aren't as much of a concern as they were just, let's call it, 3 months ago. So I believe there are still opportunities with respect to AI, but look beyond just the semiconductors and chips. Look at the data centers, look at the cooling solutions, look at the power providers through utility companies. There's tremendous opportunities there, Greg.
And then finally, are you looking also towards the bond market? I mentioned that the dollar has come down because you're not getting as many foreign buyers, so they say, into our auctions buying our treasuries. That lessens demand for the dollar.
Yes.
So when you're watching the bond market, what are you seeing?
I'm seeing a tremendous opportunities right now in the investment grade bond space, whether it's treasury securities, corporate bonds, or even municipal bonds. We saw significant spikes in yields. Yields go up as prices come down. that creates a very attractive entry point to buy those coupon payments over a longer period of time. So if you're an income-oriented investor and you're looking for a dependable stream of income and also total return potential, consider these investment-grade bonds, particularly municipal bonds, as it relates to the tax-free income they provide.
All right, well, thanks for coming on and talking about it.
My pleasure, Greg.